Right. Let's unpack this. We've got a fascinating stack of sources today, pulling excerpts from two real investment giants, John Bogle's Common Sense on Mutual Funds, and of course, Benjamin Graham and David Dodd's Classic Security Analysis.
Yeah, and what's really interesting here is how these, well, quite different perspectives, different eras, different investment types, even they both sort of touch upon a core idea for protecting your investment.
Finding your lifeline almost.
Exactly. Think of it like that. Graham and Dodd, they call it promise safety, or famously, the margin of safety.
Hmm.
Bogle uses different language, like a margin of advantage, often through controlling costs.
Right. It's really all about finding that solid ground,
Yeah.
especially when the market gets shaky,
Right.
or even just making sure you're not losing value when you don't need to.
Mm-hmm.
So our mission for this deep dive, let's extract the key nuggets from these specific sources about building that safety, understanding value, and hopefully help you navigate all the noise out there by focusing on this, well, absolutely vital concept for your portfolio.
Sounds good. Where should we start? Graham and Dodd.
Let's do it. So diving into the Graham and Dodd material first, their core principle really revolves around buying assets for, well, significantly less than their intrinsic worth, their tangible worth.
And that gap, that difference, that's what provides the promised safety they talk about.
Precisely. It's like having a built-in buffer, isn't it? Against bad news, market drops, you name it.
Yeah, cushion. They even gave historical examples, I think, like some South Korean stocks they found way undervalued during a sector downturn. Showed that buffer working in practice.
So that raises the big question then, how do you actually figure out that tangible worth or intrinsic value? It's not always obvious.
No, it's not. And the sources, they really emphasize, rigorous analysis, digging into the financial statements.
Peeling back the layers, as they say.
Exactly. Looking beyond just the headline income number,
Raw.
understanding, say, non-recurrent items, those one-off things that aren't part of the core business,
Mm-hmm.
or how a company accounts for stuff like property retirements.
Mm.
It's all critical for establishing that safety margin. You need to see the true underlying financial picture, not just the potentially polished version.
Right. Understanding the real financial picture is the bedrock. Makes sense. And they also talk about safety with bonds too, right? Looking at things like interest coverage, conservative debt structures.
They do. But there's a key point they make there too. Even strong coverage numbers, like a company earning many times its interest payments, that can evaporate if the core earning power suddenly disappears.
Ah, good point. So the history isn't always the future.
Not necessarily. So they even talked about requiring companies to maintain a kind of cushion. Net current assets, think easily sellable stuff minus short-term debts relative to their bond obligations.
Yeah.
Just another layer of safety built into the balance sheet structure.
Okay, so connecting this all together, the Graham-Dodd sources seem packed with examples where the market price just didn't match up with the underlying value.
Oh, definitely. They mentioned things like a preferred stock that kept trading higher just because of piled up dividends, even when profits were low. The market was focused on the wrong thing.
Interesting.
Or a company that liquidated, sold itself off piece by piece for way more than its stock market price suggested it was worth. Clear undervaluation.
So these examples really highlight that opportunities can exist when the market's maybe not being perfectly efficient, and that gap you find between price and value.
That's your margin of safety. That's the buffer.
Okay, let's switch gears now, because the Bogle excerpts, they come at safety from a different angle, talking about this margin of advantage you get with low-cost index funds.
Yeah, it's a different take, but still very much about protection, in a way.
How so?
Well, Bogle's material just hammers home how costs, fees, expenses,
Yeah.
how they relentlessly erode your returns over time. It's significant.
That tyranny of compounding phrase he uses.
That's the one. It works against you with costs. So high costs are this predictable drag on your wealth. They directly increase your risk of just underperforming the market average over the long haul.
Simply because you're paying more friction.
Exactly. And the sources, they point to Morningstar data showing index funds often have substantially lower risk profiles than actively managed funds.
Why is that? Less volatility.
Partly, yes. But also they avoid the risks that come with active stock picking, getting it wrong, behavioral biases influencing decisions. So Bogle presents simplicity, and especially focusing on minimizing costs as these crucial secrets to investment success.
Because they protect your actual wealth accumulation from being eaten away by predictable fees. It's a different kind of safety margin, maybe.
I think that's a fair way to put it, protecting your net return.
So wrapping this up, What does this all mean for you, the listener? Looking at these sources together, Graham and Dodd focus on finding that promised safety through deep value analysis, looking at the balance sheet.
While Bogle highlights the relentless drag of costs and the risk reduction you get from, say, broad low-cost indexing.
But the core message, it seems pretty powerful and consistent, doesn't it? Building a robust investment approach means, well, thoughtful analysis and actively protecting yourself against the obvious risks, be it overpaying or letting costs drain your returns.
Absolutely. Which I think leads to an important question for everyone listening. If these foundational texts, written decades apart, point so strongly towards understanding true value, demanding some kind of buffer or advantage, and minimizing costs, if those are key to protecting and growing your capital,
Mm.
well, what does that imply about how you should approach every single investment decision you make from here on out? Especially when finding those obvious margins of safety, in either Graham's sense or Bogle's, might feel harder in today's market.